Welcome to Marmor webinar series. My name is Rajesh and I work as a senior analyst with Marmor. Marmor is a majority-owned subsidiary of Kuwait Financial Center Marcus. Established in 2010, Marmor has developed full-fledged research capabilities covering multiple areas such as infrastructure, economic research, capital market study, and policy analysis. Marmor serves the interdisciplinary knowledge needs of its client and stakeholders. In today's session, I'll be discussing and analyzing the impact of Brexit event on GCC Economies. Questions, if any, could be asked at any point of time during the course of webinar, and it shall be addressed at the end of the presentation. Recording of the presentation will be sent in a day or two, and the same will also be uploaded on the Marmor website as well as our YouTube channel. We'll start with the presentation now. The recent event of Britain's exit from European Union, which is currently dubbed as Brexit, has been a landmark event in the second half of the 2016. And as investors from GCC, we are concerned about its impact too, which has created worldwide ripples. In today's webinar session, we'll be assessing the impact of the event through various channels with a particular focus on GCC economy. So in essential, we'll be analyzing the impact of the event on the economy of GCC, how it could affect the trade and investments, what will happen due to the depreciation of various currencies, what will happen, what is the impact due to the appreciation of USD against the other currency, in particularly Britain pound, what will be the impact on oil, and how it could affect the non-oil sectors in GCC. We have split the presentation into three categories. In the first section, I'll be discussing what exactly is the event and what it portends for the global economy. In the second section, we'll see what are the various channels through which GCC economies would be affected. And in the third and final part of the webinar, I'll be discussing how much of investments have been made in Britain by GCC investors and what will be the impact on those investments. We'll move ahead with the first section of the webinar. In order to assess the importance of the event, what we have done is we have taken the CBOE, which is Chicago Board of Options Equity Market Volatility Index. In this, if you see, this index particularly captures the investor's fear for any particular event. If you see, we have taken the past almost 9 years data, and you can see the volatility of the markets across the time period. And Brexit event has created a spike in the volatility index to a level of 30, which is much lower compared to the key recent events like devaluation move by China, or even the global financial crisis post the Lehman fallout had created the most volatility. So assessing all these key events like Lehman fallout, flash crash in June 10, US debt downgrade, and China devaluation, the impact of Brexit, which happened in June, is a little insignificant. This could be due to various reasons. One, the event was well discussed, and two, the impact of the event was quite well known to the investors, and investors may be, as the market implies, are quite well prepared for the event. It wasn't like too big a fact which could affect their investments. In comparison with other events such as China devaluation, which the market never expected, nor the Lehman fallout and the flash crash. So that's one reason why the volatility index has spiked only to a level of 30 following the event of Brexit. This doesn't mean that the markets didn't react since most of the investors were are well aware of the how the Brexit event could play out. As we can see, the one-day change in markets following the event of Brexit. Incidentally, in UK, the markets lost only 3% following the outcome of Brexit, but other markets in European Union, such as France, Japan, and Germany, were the most affected. The event didn't just create ripples in European Union, but the effect of the event was felt worldwide. In particular, in GCC, the markets of Dubai suffered the most, while the other markets, they fell in line along with the global equities. And a clear transition from equities to safe haven assets such as gold and dollar index as well as treasuries, US treasuries was found. So that's the reason why we have the risk-free assets such as gold increasing. Where on the other hand, countries in the European Union such as Germany, Japan, France had a significant fall. UK fell to a certain extent, but not as much as the countries which are major EU countries like Germany and France. In the case of GCC, only Dubai market suffered. This could be because Dubai is primarily a trading hub, and any impact in EU could affect the trading the value of imports and exports, and that's one reason we feel Dubai could have been most impacted because of this event. The currency of Britain, which is the pound, which we refer to as GBP, also lost a significant value against the GCC currencies, in particular UAE dirham. This is because most of the GCC currencies are pegged to US dollar, and with the fallout of Britain vote to come out of Brexit, to come out of European Union, which is dubbed as a Brexit, it created a fear in the minds of the investors that the investments which are being made in Britain could flow out because as the complications weren't very clear, unclear. So this caused a loss in the currency value of Britain, and the British pound lost almost 7.2% on a single day against USD as well as UAE dirham. So what the major impact of this is any investments made by foreign investors, such as in particular the Gulf Kuwait investors, the depreciation of currency would directly knock off the value of the investments made. So in case of the currency over a period of time since Brexit, if it had lost by 10%, even your value of investments is going to be knocked off by 10%, which is very significant. And this is in addition to the uncertain outlook due to which the asset classes could be still further affected. So a straight away knock of 10 to 15% is like pretty huge. So what is the event portends for the global economy? One, despite most of the major polls and major forecasters being divided about the opinion of Brexit, most of them thought Britain will vote to stay within the European Union. But unfortunately, the vote came out in favor of Britain exiting European Union, and there's just a referendum vote. It's not a final decision. The decision still involves a long-drawn process with multiple, process to play out. So for the time being, we try to understand why exactly the people of Britain voted in favor to come out of European Union in the referendum, which happened in June 23. The split is not a very wide split. Those who voted in favor of Britain coming out of European Union stood at 52% against 48%. And there are numerous analysis which is available stating who voted for what, which city voted for what, how does the voting, is made across age groups and stuff. In general, based on those analysis, it is believed that those who are well off and those who lived in metropolitan cities and those who are at the youngest stage of their life, who are just starting out their careers and stuff, they seem to have voted in favor of Britain being within EU. That's because they felt that Britain staying in EU would offer them a lot of opportunities due to globalization, free movement of trade and goods, free movement of human capital, and it presents them with the wide opportunities. On the contrary, those who seem to have voted against Britain staying within EU, they seem to majorly come from daily wage earners, the lower income groups, and typically those who felt that their incomes are being stagnated or their jobs are being taken away by immigrants, and most of them from manufacturing did vote for Britain exiting from the European Union. The primary reasons is, one, there is a growing case of inequality among the masses. In a capitalistic economy, we can clearly divide based on this two sets of people. One, those who, the primary industrial owners, the entrepreneurs and stuff. Another, the working classes. The working classes, due to various technological advances, they feel their incomes are being stagnated, their productive levels are, plateauing. So they don't really have a case to argue for higher incomes. So But on the other side, the capitalists, being encouraged by the globalization practices and due to the practice of outsourcing, the pretty mundane jobs to lower income countries like Vietnam, or maybe Philippines or India, they feel their jobs, even the jobs which are not, where the income is pretty stagnating, they feel that even they are missing out on the jobs in few industries, wherein the manufacturing is being shifted to lower based countries such as Taiwan and Korea or maybe even China. So they thought, the openness in economy should be good to a certain extent, and they felt being in the European Union doesn't serve their purpose. And as a sign of backlash to globalization, they seem to have voted against Britain staying in the European Union. So this just sets the stage for our presentation. We move on to the next section, wherein we'll be talking about the various channels through which the GCC economies will be impacted. We foresee four major channels through which the event could play out and affect the GCC economies. The first and foremost is how it could impact the GCC economic growth. One, Britain coming out of European Union is not just a simple process. It's still a long drawn process. Only the referendum voting has taken place. So what will happen is this will plunge the European Union into a constitutional crisis, wherein the major political leaders will be devoting most of their time to sort out this issue and debate whether Britain should be allowed to leave the European Union. In case if it does wants to leave the European Union, how should the deals should be transacted? How should the agreement should be negotiated and stuff? So this is going to take away a lot of leadership time away from the economic problems. So capital expenditures would be delayed, and all this uncertainty would dent the consumer confidence. The consumers won't be confident to spend on the economy. Maybe they'll be delaying all their big ticket purchases, like if someone is interested in buying home or making entrepreneurial decision, all this uncertainty will hold them back, and this is a big disadvantage for the global economic growth, which is already sagging, as evidenced by the IMF, which keeps continuously downgrading the growth forecast. On the alternative, all this uncertainty will push the investors towards safe haven assets such as US Treasuries. As we have seen, the yield has during the time of Brexit, and from the current level of US yield, we have already seen an improvement to the tune of 20 bips. So this is very significant, and it would also make the US dollar much stronger. And with the US dollar being stronger, it indirectly means the GCC currencies are also being stronger against other currencies. That's the way in which it could impact the economic channels. The other major pillar through which the impact would be felt is the interest rates. As we all know, GCC currencies are pegged to the US dollar, with Kuwait being the exception, wherein the Kuwait currency is pegged to a basket of currencies. And in this basket, again, the majority is believed to be US dollar. So typically, these GCC countries follow the interest rates which the US Fed follows and tracks. So what happens is all this uncertainty has already put off US from normalizing the interest rates. And even in the recent Fed meeting, the Fed chairman has said, they are waiting, still awaiting for more data and clarity before they take a decision to hike interest rates. So this, in a way, is a positive for GCC countries. This is for two reasons. One, GCC countries are already bruised because of the lower oil prices, and oil prices are still falling down. So in such a scenario, having low interest rates indirectly, helps them to, continue their monetary expansionary policies and help them to revive the economy. And two, GCC economies, because of loss of oil revenues, they have been scurrying around in the sovereign bond markets and the global bond markets. They have been actively taking loans from a consortium of international banks. They have been issuing sovereign bonds and stuff. Lower interest, with the interest rates being lower for longer, this can only act as a good sign for them. So in a way, this is positive for the GCC governments. When we try to analyze the impact through the trade channel, we see that there is no free trade agreement currently between European Union and GCC. So there is no case for renegotiation on that, or any amendments to be made. And still the FTA is pending. The trade wouldn't be that affected between European Union and GCC, nor within Britain and GCC. It's again is an advantage for GCC countries because the event of Brexit, wherein if at all it plays out, Britain having lost it, assuming it has lost its access to the common market of EU, Britain would be more than happy to sign bilateral trade deals with any country which is willing to do. And in such a scenario, GCC Britain would love to lap up that opportunity to sign a trade deal with GCC, and this we consider as a positive for GCC. But the only negative impact of this Brexit is GCC investors have made a sizable quantity of investments, particularly in Britain, especially in the real estate. So what happens is we had a lot of financial firms coming into Britain, with London being a global financial center, and a lot of multinational organizations like Goldman Sachs, Morgan Stanley, and Credit Suisse has paid sizable number of their bankers and financiers in London financial districts only because they had the passporting rights to travel across EU to carry out business functions and stuff. So when, if at all, the Brexit plays out and Britain loses the passporting rights to transport its human capital freely across European Union, there is a huge possibility of the London being a super financial hub being dented, and it could lead to rise of alternative financial centers like Frankfurt and Paris. So this, in a way, could affect the commercial reality. And we also feel that the lowering of pound value and the Britain index, the London Stock Exchange's fall could further impact because GCC investors have made some sizable investments in both the real estate as well as the listed equities in London Stock Exchange. So these are roughly the various challenges through which the event could play out. We'll go to the next session of a webinar wherein we'll be talking more in depth about the kind of investment which GCC investors have made and the quantum of investments, and in particular how exactly the investments are being affected, and maybe we'll also deal with the outlook for those investments. One of the major investments which GCC investors have made is in the asset class of real estate. Even among European Union, when we consider the quantum of real estate investments made by GCC investors in European Union, Britain roughly accounts for 40% of real estate investments being made. So the attractiveness of Britain real estate lies in the vibrant hub of London, which has this Canary Wharf financial district, the prime properties of Mayfair, the Olympic villages, the Harrods department store and stuff, where the sovereign wealth funds have been very active in recent times, acquiring various residential complexes, commercial reality, and various buildings and complexes within the Canary Wharf financial district and in the Olympic village. So as from GCC perspective, we are more concerned about what exactly will happen to the real estate market due to the event. We have already seen since the start of 2016 investors being very hesitant to close the real estate deals which they have been under discussion. So based on the data, the short-term performance of the real estate markets, both the residential, commercial, has been muted in the first 2 quarters, and the outlook for the same is also quite bleak, considering the huge uncertainty revolving around the exact process of Britain and what would be the exact outcome. And more importantly, London as a financial hub could be threatened, as we already discussed. And this could, this is majorly because, in case if the Britain comes out of European Union, the passporting rights would be revoked. The human capital won't be able to freely travel across the European borders from Britain. Britain would be isolated. And as a result, since you represent a bigger market than Britain as an standalone basis, it could lead to rise of alternative financial centers such as Frankfurt and Paris, and this has a huge impact on the the commercial reality office space And there have been a few news wherein Credit Suisse has already transferred its key employees to the tune of 4,000 people from its organization in London to Frankfurt. And there have been several threats from other bankers too, wherein they stated that they would be changing the employees from London to alternative places in European Union. So this is a significant threat for Britain. And even those who had typically tried to invest in London because of its attractiveness as a real estate market have been on wait and watch mode. And we have seen a lot of transactions, being held back, and the volumes of transaction have also visibly slowed down. So these are the primary signs which we have felt so far in the Britain real estate market. And we believe this is how the sentiments could play forth in the real estate market. Initially, for a GCC investor, when the pound falls by say 8 to 10%, the investment value is also going to be knocked off in the similar way. This for all the overseas investors, including the GCC investors. And once the outcome, which is not still clear regarding the process, as well as whether they would go for another referendum, or how exactly the event could play out, is still not clear. So this creates a lot of uncertainty in the minds of investors, and such negative sentiments would still further depress the asset prices in the short term. And we believe that the transaction volumes would still continue to trickle down, and at best it could remain, or and at worst it could still further thin down. And this could maybe play out for the next 2 or 3 quarters, and once some sort of clarity could emerge, maybe then those who haven't earlier invested in London would be more interested because of the pound fall and the short-term negativity, persisting of short-term negativity. So they could find the assets to be attractive, and this could lead to renewed demand from new investors. And once this comes in, maybe say after 3 quarters or 4 quarters, or maybe even after 18 months, and once significant clarity emerges, we believe the asset class would again pick up, the real estate asset class in Britain would again pick up. And Britain, despite even if it is away from European Union, it has its own inherent advantages, wherein it has a significant population of almost 60 million of high net worth people. And it's just a growing hub because of various activities which are currently going on. And we believe real estate market would pick up, but in the short term, the pain would linger on. Apart from real estate, we also consider the impact on the equities as asset class. The GCC investors, apart from having owning a sizable portion of equities listed in London, the key sovereign wealth funds also have some investments made. And in this presentation, we'll be considering only the sovereign wealth fund allocation to London equities. Out of the three, this is completely based on the publicly available data which we have. And from the data available, we see that the Qatar Investment Authority has the most exposure at almost 6.5 billion US dollars. And we see, based on the composition and today's performance as of June, they seem to have suffered a fall of 20% in the year itself, and the year is not yet over. While Abu Dhabi, which has a more diversified constituents out of its exposure to, which is roughly around $3 billion, has suffered the least at 2% fall. While Kuwait Investment Authority, which again has a well-diversified firm, has the least exposure to equities which are listed in London, but despite the value of investments being quite less, the volume of investments being quite less, the value has knocked off by 12%. The main reason why there is a huge disparity in performance between Kuwait Investment Authority and say Abu Dhabi Investment Authority, which has suffered only 2% fall against the fall of almost 20% for Qatar, is Qatar has sizable stakes in the financials, especially it owns almost like 5% in Barclays, and it also has sizable exposure in Royal Dutch Shell, almost like I think it's a 0.9% stake in Royal Dutch Shell. And these are some of the companies, the financials and oil and gas sector, which hasn't been performing well. And Barclays suffered a huge fall, and that's one reason why Qatar Investment Authority stands exposed to a 20% fall in London equities. On an overall basis, due to the knock in the currency value, as we told before, directly would lower the investment value. And among equities, it's the returns which we showed in the previous slide is on a USD base. It's on local currency basis. So when we account for the fall in currency value too, we see that Qatar has almost lost like 25 to 30%. And Abu Dhabi, it's almost like 10%, and Kuwait, it's almost another 20%. So it's not just the loss in equity in value in local currency terms, but local currency terms, we need to also consider the currency depreciation. And overall exposure of the GCC investors in real estate markets is almost like 45 billion. This spread across residential markets and commercial markets. In residential, already the prices of the markets are down and the transactions aren't happening. It's almost down 5% for the year. And as we have seen in the near term and the short term, the markets will still be depressed. But over a time, once the overseas investors who haven't made any investments in London for quite some time, or who have missed the bus earlier, would find the markets to be attractive. And once they pulse, and the cycle could turn, and we could see investments rising up. And in commercial reality, as we said, there are already concerns of oversupply, and with London portion as a financial hub being threatened, we could face some significant pressures in the short term. Rentals have already been affected. We have news trickling down that the rentals are being negotiated at the lower end. So that's something which the commercial investors should be worried about. When we talk about various asset classes, we also dwell into the commodity asset class, and from GCC perspective, oil is the most important. Though oil has been falling currently, it's majorly due to the oversupply concerns, and Brexit event as such hasn't had much of an impact on oil. But we feel that, I mean, there is a very indirect link between the event Brexit and oil. If at all, if Britain plunges into recession, due to its exit from euro, and it has a knockdown effect on other European countries, plunging the entire eurozone into a recession, then oil would definitely be affected, as it's already a well supplied market, and with demand flattering, we see further downside pressures too. So what exactly is going to happen? I mean, I kept talking about the various uncertainty which is being caused by the Brexit. So what are the next steps which the government would be taking, or how could the event pan out? One, no one is quite aware of how exactly the process is, because there has not been much of a precedent for such a event. And the major talks is that Germany, which is heading out the Eurozone, will do everything in its capacity to keep Britain within the Eurozone, European Union. This is because, I mean, if Britain is able to carve itself out of the European Union, maybe other countries could follow its lead, and it could eventually result in disintegration of the European Union, which ideally shouldn't happen for various reasons. So how exactly it could do is, I mean, European Union would still negotiate hard, and it will go for hard bargaining. And in case of Britain, which would, Britain wouldn't like to leave out its access to the common market of European Union, as it represents a significant market for its goods and services. So this will lead to a subtle trade-off between European Union demanding a free movement of people across Britain borders, while Britain could keep pushing, in case if I'm gonna allow it, maybe I need access to full market of European Union. So this is something which we need to watch for, and we believe these are the two key things which should ideally be discussed under the various negotiations. And we come to the end of the presentation. So we initially said like these are the various channels through which the economy of GCC would be affected. So we here present with the snapshot. On a overall basis, two things work out favorably for GCC. One, the persistence of lower interest rates would help GCC, which are already battered on because of lower oil prices and have been raising various avenues, capital from various avenues such as loans and bonds. For them, having the interest rates lower for longer would be pretty helpful. And two, GCC doesn't have a free trade agreement with the European Union, so trade wouldn't be affected. On the other hand, in the case of Brexit, yeah, Britain would be more interested to sign a bilateral deal with any country which is willing to. In such a case, GCC would be most benefited because of its ability to sign a free trade deal with UK. Investments, it's negative because of currency depreciation as well as the current depressed market, especially in the commercial sector, where the rentals are being already pressurized. Oil will take further time to for this to play out, so it's too early to make a judgment call. With regard to non-oil sectors, tourism is one which would be affected. UK, because of its currency depreciation, will find it hard and expensive to make a travel. Just 10% depreciation will increase the traveling or the tour expenses by almost 10%. So we have a similar precedent wherein when Russian ruble, its local currency, depreciated by almost 30% once US put sanctions on Russia. We saw that, I mean, the Russian tourists who usually flock Dubai literally trickled down to very few numbers. And in Dubai, tourists from UK form a sizable number. It's not just the tourists, even investments into Dubai real estate market are being made by a lot of Britishers. So for them, having the prices being raised by almost 10% due to the change in currency value would make them think twice about their decisions. So this in a way is negative. But on the other hand, GCC are like the fifth largest market, export markets for the European Union, and any change the value of the currencies would be pretty helpful for the GCC countries, which keep importing a lot of capital goods, automobiles from Britain. So with this, we come to the end of the session. In case if you have any questions, you can let us know. Alternatively, you could also email us. The copy of the presentation will be sent to your registered email IDs. Alternatively, we would also, upload this presentation in our website. The presentation will also be hosted in our YouTube channel. We hope you enjoy the presentation. Thank you.